It's January 2021. The American Revolution got a really bad sequel. Donald Trump is no longer president, and Joe Biden is sworn in, and Activision has finally decided to nerf the DMR. January was an absolutely insane month, but buckle up. The stock market is about to go bananas.
Checkout shares at GameStop surging another 51% today. The record move driven by a retail rebellion.
That's right, GameStop, the blockbuster of video games. Home of the most one-sided trade deals in history. A company stock that has not gone over $60 in the past 10 years and seen its value steadily decline as investors doubt its long-term viability. And can you blame them? For a company so heavily dependent on in-person sales of video games, it is sure as hell worrying when consumers prefer to purchase their games online or when console manufacturers build systems that eliminate you altogether. In the eyes of the market, GameStop is an old man on his deathbed, awaiting the inevitable. So it is mind-blowing to see GameStop blow by $60 in such a short span of time. And it was only the beginning.
Shares of GameStop now 123 and change, another record high, up more than 450% to start the year. Our next
guest, GameStop. It's surging after hours. Of course it is. The move coming after Tesla CEO Elon Musk tweeted, "Game stunk," with 2 exclamation points, with a link to the Wall Street Bets Reddit thread on GameStop. Our next guest.
In the meantime, video game retailer GameStop is set to continue their head-spinning ascent today. Shares are now up more than 60% pre-market amid an ongoing battle between bullish day traders and hedge fund short sellers that have bet against the stock. GameStop shares have now risen some 700% year to date.
Now to a wild ride on Wall Street that seems to have just come right out of the blue this morning. It has officials and investors buzzing. So here's how it goes. Shares of the video game retailer GameStop have suddenly become a white-hot must-own, skyrocketing over the last week or so.
As much as we love to see GameStop stock explode to record highs, it is an unfortunate sign that the stock market is broken. I know. Before you tell me, wasn't this a fight between hedge funds and Wall Street bets? Yes, but I'd rather characterize this fight between retail investors flush with cash, thanks to the economic stimulus, also known as stimmies, and cash-heavy, reckless institutional investors.
The Wall Street bets crowd can easily find stocks with big short positions. You can look them up. It's not a problem. GameStop was ludicrously shorted. More than 148% of the stock had been sold short, which is nuts. For years, betting against this thing has been like shooting fish in a barrel. But they forgot what can happen when the longs gang up on you.
Shorting GameStop 150% of the float is absolutely stupid. The hedge funds that took part in it got burned. The run-up of GameStop shares wasn't solely done by retail traders, but other hedge funds took part as well. Because if you and I are making money, you're sure as hell know that they're making money as well. And if you think these institutional investors won't stab each other in the back for a quick buck, then you're a bigger clown than I give you credit for. The insanity of the stock market was everywhere. Google is up 83%, Facebook is up 40%, so is Microsoft. The entire NASDAQ is up 35%, the Dow is up 27%. All while a pandemic rages on. You probably have a few questions. Why is the stock market exploding? Is this like the 2008 housing bubble? Is AMC going to the moon? Is Arsenal still a big team? Although I have the answers to all your questions, I will be only answering why the stock market is going crazy. This forced governments to institute lockdowns, which meant the closures of offices, schools, and non-essential businesses, which further aggravated the huge fall in consumption and the steep rises in unemployment and bankruptcy filings. Investor concerns quickly blew up from significant concern to a full-on panic.
Let us recap how this incredible day played out. The Dow just had its biggest point drop in history, falling 1,190 points. That was a 4.4% drop. The Dow index has now lost 3,200 points this week alone It is now down nearly 10% this year.
This drop wasn't good. The sell orders from the institutional investors caused the entire market to crash. But you're probably asking, if they were selling, what were they buying? Well, it's a good thing I'm here, because I'm about to tell you. Well, for one thing, they didn't sell and decide to hold cash. If there's anything institutional investors hate, it's cash, because cash offers zero returns. So what do you buy in a time of crisis? Well, the safest investment out there, one with no risk and guaranteed returns. It is the U.S. Treasury. It is basically a bond issued by the federal government of the United States, handled and managed by the U.S. Treasury. It is so safe that insurance funds, pension funds, and nation funds buy U.S. Treasuries. These bonds are backed by America, home to the largest economy, secured by the strongest military, and overlooked by the most powerful financial institution known to man. And because
Lannister always pays his debts.
Let's go back to the market crashing. When investors lose confidence in the stock market, they flee to the U.S. Treasury market. So here is the U.S. Treasury market, the place where you buy and sell U.S. Treasuries. Now that investors are selling their stocks, they want to buy more U.S. Treasuries, thus increasing demand. With supply not seeing any significant change, the price of U.S. Treasuries would go up. Now let's get to another important aspect of the U.S. Treasury market. Yield in the Treasury is determined by the annual interest the Treasury is paying you divided by the price in which you paid for the Treasury. With investors fleeing the stock market, pushing up the price of Treasuries, all while the annual interest payment of the Treasury staying the same, it would mean the yields on these Treasuries would fall. And so they did.
Below 1% then on US 10-year. This is a 150-year first, as Matt was just saying. What is the lower bound for that now, Hugh?
I don't think we know what that is, simply because I think the market is extrapolating now that the Fed are going to find it very difficult to stop. Because in my expectation, the data in the US is going to deteriorate over the coming months as the real impact of this virus starts to feed through.
Another record-breaking day, he said, in the bond market. It's been a long week. The yield on the 10-year Treasury hitting a new record low, breaking below 0.7%, closed at 0.773.
As these markets were crashing, the Federal Reserve did nothing. Like Kyle, they believed the markets were stabilized on their own. Who is Kyle? He's a frat college kid that took a few econ courses and thinks he's the next Milton Friedman. Who is Milton Friedman? He is a Nick Merckx of economists. Who is Nick Merckx? He is a Bernie Madoff of Warzone streaming. And who is Bernie Madoff? He is the undisputed goat of stealing from the rich. He's like Robin Hood, the Englishman who stole from the rich to give to the poor. Not to be confused with this Robin Hood, which steals from the poor to give to the rich. The Federal Reserve will soon learn that by doing nothing, they have made a huge mistake.
On what we just witnessed today, that was brutal.
Obviously brutal. I mean, the markets rushed toward a place to say we have to start handicapping the probabilities of a recession in this country. Certainly, we haven't priced that in right yet. The verdict is not yet in.
After mounting pressure, the Federal Reserve attempted to stabilize the markets.
Tonight, the Federal Reserve announcing rare emergency action to calm financial fears, cutting interest rates to near 0%, their lowest level since the Great Recession. Since the record highs last month, the Dow is now down 21%.
The Federal Reserve announced these actions on Sunday, timing it one day before markets reopen. These actions were bold, but not bold enough.
The opening bell, followed by another plunge in the market and a halt to trading on the New York Stock Exchange. By the end of the day, the Dow down 12.9% and the S&P down 11.9%. The worst percentage drop by both since 1987.
The markets were sending a signal that the Federal Reserve doing nothing was not as bad as the Federal Reserve doing little. If the Federal Reserve wanted to stabilize the markets, they need to take audacious and daring actions. and they needed to do it now.
Also on Monday, the Federal Reserve rolled out unprecedented programs to aid U.S. businesses, employers, and consumers amid the pandemic. It took its liquidity-providing efforts to another level by pledging unlimited quantitative easing. The Fed said it will continue its asset purchasing program in the amounts needed to support the smooth functioning of the markets. Just a week since the Fed announced it will spend $700 billion on new bond purchases, it explained it would buy $375 billion of Treasury securities and $250 billion in mortgage securities this week.
The Federal Reserve hit back, and they hit hard. But would it be enough to calm the markets? Well, frankly, it was overkill.
This is one of the first times, I think, Andrew, that the Federal Reserve has announced something and the market has actually gone up.
Before we go over how the markets responded, we must go over what the Federal Reserve did and how it affected the stock market. The Federal Reserve decided to buy billions of dollars worth of U.S. Treasuries. This would cause demand for Treasuries to rise drastically, and their purchases were so massive that it even dropped supply, meaning a steep rise in the price of Treasuries. With market prices rising and Treasury payments remaining about the same, it would mean a considerable decrease in yields. Since the Federal Reserve was gutting the returns on U.S. Treasuries, it forced institutional investors to choose between no returns or higher risk. And they chose higher risk. This meant they would be moving their funds out of the U.S. Treasury markets and into the stock, real estate, and crypto markets. And since those markets be rising due to this new money flow, while the Federal Reserve was keeping Treasury yields down, it would cause even more money to leave the Treasury market.
Here, we're getting the closing bells, or what would be normally the closing bells if the NYSE were open. You can see where we're ending right now. The Dow Jones Industrial Average having a monster day today, up 11.2%. And just checking that right now, this is actually depending on how it all settles out. This is going to be the biggest one-day percentage gain for the Dow Jones Industrial Average since March 15th, 1933, if you can believe it.
Let's get to Bob Pisani. Morning, Bob.
Good morning, guys. This is a second day in a row we've had a gap up in the S&P 500. Do you know we're up almost 10% this week? This week. It's only the second day of the week overall here. 20% off the lows. A lot of debate about whether we're in a new bull market. People arguing about that.
We start off with the Nasdaq's record day. The index closing above 10,000 for the first time ever, led by big names like Amazon, Apple, and Microsoft.
The Federal Reserve kept printing money, kept buying up treasuries, which meant the bulls would continue to run up the market.
Take a look at the Dow this morning as we are looking for 30K. We need 408 points, actually 408.73. Tantalizingly close here, John, and I think we just did it. Another historic milestone for the Dow at 30K for the first time ever.
We start with another record day for the markets. The S&P, NASDAQ, and Dow all closing at new all-time highs. The NASDAQ, the big standout, with a 2.5% gain. The VIX remaining in check, the 10-year yield at its highest level since late March. All of this playing out on Wall Street.
It was a great time to be in the stock market. Everything was going up, and there was no sign of a slowdown. But something was lurking in the background. There were growing signs of inflation. What is inflation? Inflation is the increase in the general price level of goods and services. If some goods cost a certain amount of money at one point and it costs more for those same goods at some point in the future, you have witnessed inflation. Why is inflation bad? Well, inflation isn't really bad. Too much inflation isn't good, and too little inflation is not that great either. But the important question is, why is inflation bad for U.S. Treasuries? Well, here's a U.S. Treasury. It pays them the same amount every 6 months, and you use that money to buy a battle pass like a tryhard. 6 months go by, and you get paid again, but this time the battle pass costs more. The price of the battle pass grew while your income did not. That is the danger of inflation to fixed income. I know what some of you are thinking. Those two battle passes are for different times, have different benefits, and even different offerings. Aren't you supposed to calculate inflation on the same good? Yes. So let me use an example with a product with no difference. Let us then see the effects on the Treasury market. First thing that would occur would be the sharp fall in demand. It is undesirable to hold fixed income in an economy facing inflation. Supply would also rise as institutional investors would start dumping their treasuries onto the market. This would lead to a significant fall in the price of treasuries. Let's go over to the yield. With inflation, fixed annual interest payments go down, as I have previously shown. However, on paper, there is no change. So in the calculation of the yield, annual interest payments remain the same. With the prices of treasuries falling, this would mean an increase in the yields of U.S. treasuries. Rising yields on U.S. treasuries could be problematic for stock and crypto markets, as increasing treasury returns could tempt some institutional investors to sell their stock and crypto holdings for treasuries, despite the growing threat of inflation.
You wrote a piece over the weekend titled "Rising Treasury Yields Flash a Warning Sign." How bright is that warning sign right now to you?
It is getting brighter, but it's not that bright. I think
rising bond yields challenging stocks and also challenging the Fed, despite the best efforts of Fed Chair Jay Powell over the past 2 days to calm markets down. Bond traders
tumbled yesterday as the 10-year Treasury yield hit a one-year high. Big tech got slammed. Microsoft lost more than 2%. Alphabet, Facebook, and Apple each losing more than 3%, while Tesla lost more than 8%.
The Federal Reserve cut interest rates and started buying up treasuries to calm the markets and to improve liquidity. They were not going to undo these actions for inflation, especially since they believe inflation is not being caused by excess demand, but rather by production capacity issues, supply chain disruptions, shortages in raw materials, and labor. So the Federal Reserve was not going to do anything just yet.
Federal Reserve is keeping interest rates unchanged and will maintain asset purchases at $120 billion a month. Now, in its policy statement, the central bank said that economic activity and employment have strengthened. It acknowledged that inflation is rising, but still said that the increase largely reflects transitory factors.
Investors couldn't believe what they were hearing. With no Fed action, the stock market would be moving to high gear.
Goodness.
I didn't spoil it.
Let it settle. Let it settle. We're right at the number.
3 record closing highs. Welcome back to Closing Bell. I'm Sarah Eisen, along with Scott Walker, who is in today for Wilford Frost. We're watching the Dow carefully because any close above 35,000, it looks like we're right there. I think Wilford would say bang on 35,000. First time ever for the Dow. It's a milestone.
Record closes for the Dow and the S&P today. The Dow finishing up about 0.5% or 162 points. For the S&P, squeaking out a record close.
As long as Powell believes that the money supply isn't causing inflation, the stock market would continue to go up. So when will the market crash? When will your portfolios burn up? I don't know when, but what I do know is what will happen before the crash. Watch out for 2 things: inflation and positive economic data, like falling unemployment or strong GDP growth. If inflation starts to grow out of control, while economic data looks promising, the Federal Reserve will be forced to take action on inflation. So what can the Federal Reserve do to handle inflation? Well, they have 3 options in hand. First option is tapering, which is basically the reduction or the complete elimination of buying up U.S. treasuries. This will cause the treasury market to behave normally once more, and market forces would push yields higher. But the yields won't grow too high to crash the stock market, but cause it to remain flat. The second option is raising interest rates, which is a more aggressive option than tapering. This would immediately cause yields to grow, as treasuries with lower yields will become cheaper. I expect this move to start the general drain from the stock market into the treasury market, which will cause stock market to decrease over time. The third option is the selling of U.S. treasuries, also known as quantitative tightening. This is by far the most aggressive option on the table. This move would absolutely tank the prices of treasuries and cause yields to skyrocket. Institutional investors would rush to the treasury market, and I expect the stock market would crash as a result. Quantitative tightening would be catastrophic. Many investors, especially retail ones, would see their portfolios shrink. The crash would only halt when fleeing investors cause yields to fall drastically, and the poor bastards still holding meme stocks.
Welcome to the Gulag. If you survive, you earn your freedom.
This is how quantitative tightening would affect the treasury market, as the Fed would be dumping their treasuries as well as no longer purchasing them. Demand would plummet and supply would climb sharply. This would result in the massive fall in the price of treasuries. As usual, this would have an effect on yields, with the market price for treasuries falling, while the annual interest payments from the treasuries remaining the same. Yields will be increasing substantially. As yields for treasuries are increasing considerably, the returns on treasuries and treasury-related investments would also be increasing. This would entice many institutional investors to close out some of their positions in the stock, crypto, and real estate markets and move these funds to the rising treasuries. By doing this, the stock and crypto markets would face market corrections, further enticing institutional investors to move their funds towards the treasury market, causing a market crash. Quantitative tightening is a powerful response, but have no fear. Chairman Powell is not a stupid man. He isn't a brave man either. He has the courage of a 10-year-old shotgun-wielding camper. So if Powell was ever going to act on inflation, it would be the softest of manner. But investors fear his response, no matter how soft it is, and the stock market has reacted at the prospect of his potential actions.
Yeah, Stephanie, I'll come to you first in terms of what it is you think that has been weighing on sentiment. Clearly, we're flat at the moment. We're only down 1.3% on the week on the S&P. Is it just Delta fears?
Well, we're flat, but the rotation has been pretty severe. And we've talked about 2021 being a year of rotation. Well, here we are again, and it's more of a defensive rotation. It is definitely Delta unknowns, but it's also the Fed and taper talk and maybe tapering coming a little bit sooner than expected, a month or two earlier than expected.
Powell may be reluctant to act, but if inflation continues to rage on, he may have to become real brave. Perhaps even sweaty, but it all depends on inflation. Now that I've shown you everything I know, I want you to be ready, to be informed, to make your own investment decisions, to be willing to log into your broker, even that one, and be ready to close out your positions. Or not. It is completely up to you. I just want you to be prepared and primed for the trying times ahead. So all I have to say is this.
Gladiators, I salute you.
This is Eric and Chicken, and you're welcome.